Still using the tools of cost behaviour, this lecture adds another important concept, that of the contribution margin. It will also introduce another concept, the margin of safety, recognising that businesses mostly operate above break-even point and managers want to know how far above, that is, what is their margin of safety. Now, we can use the contribution margin method in asking these questions. We just have to make sure that we again are clear about what the contribution margin is and how to calculate it. So here it is. The contribution margin is equal to the sales revenue less total variable costs. Or if you're doing it on a per unit basis, the price per unit, S, less the variable cost per unit, VC, and in that case then MC would be per unit. So again, the contribution margin per unit is calculated. Contribution margin equals selling price minus variable costs. The contribution margin in total is the dollar value of all of the units' contribution margins. And so if we're selling 10,000 units, then the contribution margin in total will be the contribution margin per unit times the 10,000 volume that we're selling. Just depends on what question you're asking of the data. Okay, so again, the logic of what's going on here, the contribution margin's job is first of all to cover the fixed costs, which it would do in order to break even, and then beyond covering the fixed costs, it will give us a profit. Okay, so we can see now we can put it into that little formula to calculate the break-even point in units. We can put it into the formula of fixed costs on the numerator divided by the contribution margin per unit. So we get $40,000 divided by $4 equals 10,000 units. So that's doing exactly the same logically as we did before, except this time we're using the contribution margin, which we can calculate as being $4. That's the selling price of 10 minus the variable costs of 6, leaving a contribution margin of $4. So what we're asking is, in order to cover the fixed costs, how many of those contribution margins do we need? Now, another useful relationship is this one, which is called the contribution margin ratio. Okay, so this is the contribution margin divided by sales revenue, and what you get out of this is a percentage, a contribution margin ratio, which is expressed as either 40% or sometimes you will see it expressed as 0.40. Notice that the data is exactly the same. What we're doing here is saying that out of every dollar of sales, 40 cents, let me say that again, out of every dollar of sales, 40 cents is a contribution margin, which job is to cover the fixed costs and then go to profit. So the concepts are the same, but now we take the per unit part of the discussion out, and we're just saying out of each dollar of sales, 40 cents is a contribution margin, and of course we know the difference there, of course, must be 60 cents, which is variable costs. Now, the final concept for this part of the discussion is the margin of safety. Margin of safety is the difference between what we budget or expect to be selling and break-even sales, at which point we will be making no profit and no loss. And so the margin of safety is really saying how far above break-even are we operating. We usually express that as a volume of units to sell or as a percentage of budgeted sales. Okay, so the margin of safety in terms of the volume of units is the budgeted sales minus the break-even sales. We hope and we assume for an ongoing business that budgeted sales will be well above break-even sales because we want our business to be profitable. So the margin of safety again is asking how far above break even are we operating. Expressing that as a percentage, we simply take that margin of safety volume and turn that into a percentage by dividing it by the denominator, budgeted sales. Now it's interesting and instructive to chart the relationships that we've been discussing into a break-even chart. And if a picture replaces 1,000 words, then here it is, and we can see quite clearly where the break-even point is, which will be where all of the revenues equal all of the costs. And we can see the areas of profit above that point and the areas of loss below. So here is the break-even chart depicting the circumstances of selling up to 100 output units and dollars up the vertical axis. Interesting points to note. The sales line starts at the origin, that's down at the 0, the bottom left-hand corner there, and rises linear, as we've already discussed. About 80% of the way up that, you'll see that the total cost line, which is the other line, crosses it. And by definition, where the two lines cross, that is the break-even point. So what's also important is that the sales line rises at a faster rate than the cost line. If that were not the case, then increasing volume would actually make us a smaller profit. And so it's important that the sales line is rising faster so that every item that we sell has got the potential to give us a contribution margin and ultimately a profit. Now also look at the total cost line, which is the second line. It starts higher than the sales line at the volume 0, and that's because the total cost line still has fixed costs in it, even when we're selling 0. Fixed costs are there regardless of the volume of sales. And so at sales level 0, the fixed costs are still there. And to those fixed costs, we then add on the variable costs. And so that line then goes up towards the right, but it doesn't rise as fast as the sales line, fortunately for us. Now, where the dotted line picks up the point where the two cross is the break-even point at 80 units, or if we run our eye across the left, that's about $5,400. The area of loss is the orange bit to the left of the dotted line, and the point of the loss is that the costs are greater than the sales revenues. To the right of the dotted line, we can see that the costs are less than the sales revenue, and so you can see that as the volume increases, the amount of profit increases correspondingly. Remember that you have to cover the fixed costs only once. So once they're covered, every contribution margin that you make goes straight to the bottom line as profit. Okay, now as always with these analyses, there are some assumptions and limitations. You'll look at these and you'll think they're the same as the assumptions and limitations for the linear relationship that we produced for costs, and you'd be right. Linear cost and sales functions may be too simplistic. That's true, they might. However, in being simplistic, they also give us a very powerful approximation tool. Something you must keep in mind is that this is an application which is very effective for single product firms or environments, but once you get into a multi-product environment, it becomes almost too complicated very quickly, and so we tend to use it only when we're talking about a single product environment. The problem with multi-product environments is that fixed costs are often apportioned to different products, and when we do that, it's arbitrary. Margin of safety.